you didn't have the luxury of time. You needed to come up with a plan which showed people potential, and to be able to get that into production because you want to re-rate because of where you've come from, and then build out the resource with exploration. Is that the plan?
Yeah, that's pretty much the plan. Now that we're about to show the market that, as I said, the Bateman Gold project will be commercially viable, earlier this year we've now begun exploration on what we call close proximity targets. So those would be other deposits that are within a couple of kilometres of the mine and the mill on surface. So McFinley and the Penn Zone are the first two deposits that we've started actually drilling on in the last couple of months. And part of the reason why we're looking at that is the mill is actually built, designed and constructed for 1,800 tonnes per day. In the PEA and most likely in the feasibility study, maximum throughput will only be around 1,500 or 1,550 tonnes per day. So we're only running the mill at, let's say, 80% capacity. So there's an opportunity to put incremental tonnes and therefore incremental ounces through that mill and further improve the margins for the company and its shareholders.
Right, okay, so we're starting to build a picture of what you're trying to do. So you're ramping up to that average life of mine, 1,500 tonnes a day. I get that, and the AISC is good, around sort of just under 900.
Yeah, 882 US dollars an ounce in the PEA.
So, right, so give or take 900. You're showing a route to market. You're showing that you can do this. You've inherited, as a result of the restructure, a huge infrastructure investment, some $690 million worth. And again, and sorry to leap around here, but this is quite a complex story given, again, where you've come from. That infrastructure obviously very, very valuable, and you've talked about one of the components, which is the mill. But how else was the rest of that $690 million spent?
Well, there's a 720 meter deep shaft that has a bottom and a mid shaft loading pocket. The 10-ton skips sit over the cage. So on a full production day, the hoist can bring 2,500 tons of rock to surface. So that's fairly significant. There's a wastewater treatment plant, which allows us to discharge our water. There's a tailings impoundment area, and there's a 44 kVA electrical line right into the mine site with surface transformers, converting the power down to 5 kVA and sending it underground with 2 power feeder cables. There's also a 200-man camp. Red Lake is known for not having enough labor to satisfy the labor pool or requirements. So typically 30 to 40% of the labor is fly in, fly out. So we already have that camp built, and it's in pristine condition, waiting for the new employees as we ramp up in 2021.
Okay, so it sounds like you've got a Rolls Royce, but you only use it to drive to the shops. What I'm interested in there is also, because of the amount of money that's spent, there's a huge tax loss pool presumably available to you as well, which has some value on the balance sheet at a future date.
Well, significant, because in those numbers I gave you within the PEA, at the end of the 6.2 years of mine life, despite paying no taxes, which in Ontario would amount to over 30% taxation rate, the company still had 521 million Canadian dollars of unused tax pools. And the other advantage of those tax pools is that approximately half of them could be used at some future in the evolution of the company for merger and acquisition. So for example, if you had Project A, let's say it was in Ontario, and its NPV post-tax was $100 million lower than the NPV pre-tax, if you could structure a deal and put both companies together, and provided it was accretive to both sets of shareholders, that Project A's NPV post-tax just improved by over $100 million. So the tax loss pools are not just extremely valuable to Battle North Gold, but also in M&A and potentially other strategics out there.
Okay, so you raised about $9 million in February. We've obviously had COVID. It may have impacted your ability to do work, and maybe you haven't burnt through the cash as quickly as you thought you were going to. So how much cash have you got today?
We've got just over 12 million Canadian dollars cash in the bank. Based on our current budget to year end and our current burn rate, we're fully funded through until the second quarter of 2021. And as I alluded to earlier, with the feasibility study out in early fourth quarter of this year, we would anticipate having the project financing in place sometime towards the end of the year or very early first quarter of next year.
So break that down, because again, it comes back to this business plan, which I was trying to get out of you earlier. It's trying to understand, how those numbers flow through. Your capex is, as I understand it, was it about 81 million. But you will have financial contribution to that. So what's the net number that you're going to have to raise to kind of get things moving?
Currently, we're estimating around 100 million Canadian dollars, which includes a contingency. There's also a historical legacy debt that is now, it's due the 31st of December 2021. But it amounts to today about 14.3 million Canadian dollars. But it is senior secured against the assets of the company. So if there's a debt component within the project financing, any debt provider is probably going to want to have security. So the way in which we would deal with that is we would take out the Sprott lending facility at the end of this calendar year when we're doing the project financing. So you have to add that approximate $15 million onto the capital requirements. And that's what gets us up to approximately 100 million Canadian dollars.
So you can't afford anything to go wrong between now and then, because you need to pay that off.
Well, we need to pay it off, but I mean, obviously, with the feasibility study out in September, October, if we haven't dealt with that debt in December 31st of 2021, I think there's bigger challenges or bigger issues on this project. So we're very confident that will be dealt with. Now, there's a huge opportunity here again, because we use conservative pricing in the PEA. During the pre-production period, there's 44,500 ounces of gold which actually gets produced. And at 1762 Canadian dollar gold price, that generated about $75 million of revenue from gold sales over the 20-month ramp-up period. If, however, we were producing gold next year at 24 or 2,500 Canadian dollar gold price, that extra $700 margin is going to give us an approximate additional $30 million of revenue from gold sales. And provided the capex within the feasibility study is in line with the PEA, the funding requirement just went down by the corresponding amount, i.e. $30 million less is required.